What you're about to hear next is the conversation I had on Wednesday with Aaron Levie. We go through a bunch of different stuff. We touch on Luna. We touch on the markets. We touch on Box and the public company. So as a public company, so excited for you to hear that. Okay. Well, Aaron, thank you for doing this. Appreciate sitting down. We're in Box's lovely HQ, looking out over Redwood City.
Welcome to our HQ.
It's weird to do this stuff in person again.
Yeah, this is very weird.
Yeah.
Do I look at your eyes or like a little video?
That's right. Yeah, I sort of forget the way to do actual human interaction.
Why can't I see my face right now?
Yeah, okay. It's unusual. Normally checking yourself out the entire time. You look great.
Thank you.
So, I appreciate you doing this. I think cover a bunch of topics, sort of go through market valuations, Web3, crypto, all the fun. We're going to play the hits here.
Okay, cool.
So first, I guess we're recording this on a Wednesday afternoon. And
when does it go live, you think?
Saturday morning.
Oh, man, anything could happen by then.
I know. The world could be upside down.
Luna could be priced at, we don't even know.
I think it's pretty safe to assume where Luna's headed at this point. Okay. Yeah, I was checking it out this morning. We'll get there in a second.
Fine.
But so I assume anyone that's actually listening to this knows the Box story, knows you. But maybe give us a quick, since you went public, where is Box today in its journey? What's the steady state for the company vision going forward?
Sure. So the really simple story is we started the company with a very, I think, relatively simple but broad kind of value proposition, which was we want to make it easy to access and share files from anywhere. And as we scaled the company, we sort of expanded that vision to really trying to solve all of the use cases that companies have around working with their most important content. So automating workflows around your data, being able to get e-signatures, securing your most sensitive information. And so if you think about an enterprise, it could be hundreds of employees or hundreds of thousands of employees. You're working with incredibly sensitive contracts and financial information and marketing materials and new product designs. All of that data has to be stored, secured, automated, governed. And so our platform helps organizations all around the world, about 110,000 customers now, be able to go and do that. And so since going public, we've just continued to scale the platform. We're nearing, at least our guidance was nearly $1 billion in revenue this year. And so just super focused on continuing to scale the platform with now, certainly the past couple of years with an added focus toward profitability. And so we're now a little bit above 20% operating margin. So trying to balance the both growth and... Yeah, we can get into... Is there a way to do like a sidebar lesson on...
Yeah, okay. And you said $1 billion. Yeah. That was revenue.
That was revenue.
Yeah,
that was not
that's
tokens.
unusual in my world.
Yeah.
Interesting. Well, it's quite a journey. And I guess at the time of going public, right, you guys... the financial profile of the business was much different than today.
Much worse, yes.
Yeah, much worse.
Yeah.
It's... But I mean, at the time, you guys were burning cash and focused on long-term customer health and all that. And you've grown up as both a person, I'm sure, but then also as a company in the public markets. What's that experience been like, kind of having all these public investors looking at you every day? Yeah,
I think you certainly get a much greater appreciation for how companies get valued over the long run. And I think in the Valley, we have the luxury, certainly while companies are private, of being able to think about, building great businesses. How do you build long-term durable value? And when you're in the public market, everybody wants you to build long-term durable value, but they want to immediately know how profitable is that value going to be and what's the long-term economics of that. And that's something that maybe the Valley doesn't have as much sort of kind of fluency around, at least in the private market. And then, I think private VCs sort of build these great businesses and then they sort of say, okay, the public market will now take care of it. From here. And I think there's probably could be a bit more discipline even in the earlier stages of companies as you think about, cash flow and profitability and long-term economics because when you go public, it will hit you in the face. And that certainly happened to us. And our particular dynamic was we were very, very high growth, high burn. We then became kind of lower growth, lower burn. And we then had to transition to sort of, mid growth, and actually profitability. And that's been the transition that we've been kind of going through in the past couple of years.
Well, it's impressive. I think year to date, I mean, I don't know where the stock prices are today, but year to date, SaaS, to say the least, has been underwater a little bit, but your stock price has performed quite well.
We're like a government bond. So that's
an annuity.
That's what we offer to investors in this market. No, I mean, it's, obviously multiples have come down dramatically. Our multiple was never that high. So the good news, I think for our story is there wasn't as much pressure because we never really had an inflated valuation, and we've been literally working for the past 2 years to drive a lot more profitability in the model, with a lot more to come, frankly, kind of going forward.
What's your perspective on the state of the public markets for SaaS today? Obviously, the high growth businesses are down quite a bit year to date. Do you have any broad perspective on what's going on at a macro level?
I'm very boring and simple on this, which is, again, public investors eventually, like the last shareholder that you have is going to measure you on discounted free cash flow. Like that's the only way to make the math work. And so every other shareholder up until that one, is sort of speculating maybe on what somebody will pay eventually for your asset, up until the shareholder that only cares about your cash flow. And so when you have, companies that trade at 20x or 50x or 100x revenue, and particularly if those companies aren't even profitable, you're underwriting, like years and years, maybe a decade of insane growth levels, and then the expectation that company somehow is going to transition into being wildly profitable. That's a lot of risk to take on for an investment. But there's been a lot of, kind of risk capital that's been in the market, especially, hedge funds and others that are willing to pay for that. But then, whether it was the Fed or other things that eventually sort of, said, hey, we're kind of like, we've overheated the market. These asset prices just can't be this high. You do see a dramatic unwind because there's no reason, like, why should something trade at 50x or 70x or 100x? There's almost no reason why you could ever determine any of those differences. And so the natural conclusion is that things should probably just trade at 8x or 10x, because not just for historical reasons, but that actually maths out to, at a 80% gross margin, at a 20 to 30% operating margin, that's generally what a company then would be able to produce in cash flow. And so what you'd be willing to pay for that. And so kind of anything above that is sort of just like impractical from a valuation standpoint. And you really need to be growing 50 or 100% a year with incredible economics. And so I kind of just, I mean, this is a general statement. I think the market for SaaS and cloud is as healthy as it's ever been. We're still going through a tectonic shift of IT environments moving from on-prem to the cloud, but the prices for those assets just need to be much more realistic and reasonable, given just how markets work.
Is it weird to be able to be the cerebral kind of OG gray hair weighing in on this stuff? Like back in my day, It used to be 8x.
Yeah.
And I mean, what's about you were the original kind of irreverent, young founder, and now.
Yes. I was. So first of all, it's helpful that I actually have like probably more gray hair than anybody.
The literal gray hair.
Yeah. So like actually it's I can pull it off now. But it's funny. So we burned a lot of capital as we were scaling. It's interesting. We never actually had a valuation more than maybe 10x. Yeah. Maybe we touched 15x in one round, like some kind of like crazy secondary or something. So I never even got to experience the inflated valuation period. We did burn a lot of money because we were scaling the platform, scaling engineering, being able to acquire customers that ultimately ended up proving to be a good investment strategy. But we certainly didn't get the benefit of the valuation environment. And so I think we've always been a little bit conservative on that front, simply because we never really experienced the frothy side. And it's so funny. And I was just going back and forth with Mark Cuban on Web3 stuff, and Mark was one of our initial angel investors, and he actually, at least back in the day, I can't speak to his current investment strategy, was maybe the most conservative of all investors. Like we were an angel investment. I think our valuation maybe was $750,000. That was our valuation. Okay,
USD.
Yeah, in USD, exactly. There was no other option back in 2006. So the world was USD based in at least in America, and he cared about cash flow like when we were 3 employees. So like we got that stuff built into us, and then eventually venture capitalists that we had, fortunately, were probably more on the conservative side. They cared about cash flow. We didn't generate any, but they cared about like, what will the economics of this business look like at scale. So it was all kind of, I think, relatively built into the foundation of the company. But we did burn a lot because we were definitely taking the kind of get big fast approach in the early years.
made a joke that like, all right, I'm ready to learn what free cash flow is today, and I realized my LPs probably wouldn't love that.
Yeah.
You know, it's a little too much bloodbath in the public markets to be making.
You can edit
like
that out,
right?
I'm sure.
I deleted it, so I don't think any of them watch this anyway. Well, so I guess to that end, like, what advice would you have? You guys have been through some ups and downs along the way. I think maybe when you originally filed to go public, then you took a private round with some like
we've been through
structure
everything.
around it.
Lots of ratchets everywhere.
So for CEOs and for employees that maybe are looking at their stock price and they were trading at 100 times and now they're trading at, you know, a ridiculous 8 times or whatever.
Yeah, exactly.
Like, what advice would you have for those employees or the people, the rank and file that have gone through this journey today?
Well, I mean, the really bad news is don't expect to go back to the 100x. So doesn't mean you can't go back to that value. It's just that could be 5 years of work to get back to that valuation. Just, you know, you got to keep doubling the company at a pretty reasonable rate. So I think I would look at historic norms and, you know, whether that's 2006 to 15 or 18 or whatever you want to choose, and just say, where did SaaS trade? You know, 6x, 8x, 10x, 12x. Those would all been very good valuations. Those were not sort of made up. It wasn't made up why those were the valuations. It all flows from how much profitability can a company have? What will people pay for that profitability? And then revenue is sort of just maybe a good proxy for how you can generate that. And then, you know, there's a growth rate variable there. So the higher the growth rate, obviously the higher the multiple. But you have a lot of companies that have a really high growth rate where we still don't have a lot of visibility in what's the actual underlying profitability of those customers. So kind of even growth rate sort of masks some of the value creation that we see in the value. So, you know, the first thing is possibly, unfortunately, we should expect valuations to go down and in a sustainable way. But probably, you know, less for the employees and much more for the founders and people thinking about kind of building these businesses. I think focusing on just business fundamentals, and I would say that in the frothiest of times, but certainly now it's much more appropriate, which is, you know, what's your customer acquisition cost? What's your profitability? What the unit economics of customers? You have to care about your gross margin. We have a lot of companies out there that are like 40% gross margin businesses, but they trade like they are 80% gross margin businesses. That's dangerous, because at some point that 40% difference means it's going to be much harder to get to real levels of profitability. And so I think this is some of the reckoning, which is like the market is starting to figure out what things actually have software economics and what things are software enabled businesses, but they still have the economics of whatever that historic kind of industry looks like. And that's a very different model than for how you can value a company and an asset. You know, there's a reason that you know, a Coca-Cola or Procter & Gamble, probably like 5 or 10%, you know, operating margin businesses. I'm making that up, you know, but those will not trade like a Microsoft who has a 30 or 40% operating margin. And so you have to be kind of cognizant of like what's the underlying unit economics that your business model has, and then build the company that's appropriate to that.
And so do you think that in that sense, this is actually just a healthy reset, and it's going to be psychologically difficult, and it's going to have RSU implications or option implications and reset evaluations?
100%.
But we're back to a steady state.
I don't know where we will be by Saturday and next week and the next couple of months, but the idea that we needed a correction and that is like, that's a good thing. And we need to have a more sustainable environment, a durable environment, things where you know, again, the problem with having something an investment that is, you know, trading at 100x revenue, whether it's private or public market, is that's just, at some point, that's gambling that like the thing is going to be able to sustain that. And it's way better and way healthier to build an environment where, you know, every day you show up, you build more value, you sell to more customers, you build a better company. And if you do that, if you do your work, the valuation will then incrementally sort of respond as a result of that. Otherwise, you're just paying for some company predicting what it's going to look like in 5 years from now, which again is speculation as opposed to, you know, really investing in durable businesses.
If you were a private company right now and took a 100x, 200x ARR round, right? Like, and one of the things that's interesting, and I talked a lot about this, but like public markets are consensus, and there's thousands of transactions a day, right? People agreeing on it. Private markets, you know, all it takes is one to make the market, right? And if there's one person standing there that says you're worth $1 billion, you might be worth $1 billion.
And as everybody knows, with protections though on that investment,
sure, the preferred,
and that's the little fine print on the whole thing that makes the whole thing kind of like useless as a valuation kind of methodology.
Totally,
because like they can't lose money. So you could call the thing $10 billion, And if they can't lose money, then it doesn't really matter. That's just a certain amount of like, their just appetite for upside is, they just don't have as much appetite for upside. So, but they still are protected on the downside. Keep going, sorry.
Do you think private companies are a little overly precious about down rounds, given you have down days all the time and you have up days? And like, if you had taken one of these valuations, would you think about being proactive about maybe resetting the 409A and issuing options at a lower price or resetting the valuation? Or is there too much of a psychological barrier associated with something around a down round and what that means for employees?
If I were being totally realistic, if I were in my shoes in that situation, I would probably be sensitive because
of the perception.
You have people you've hired under certain circumstances, and they have a certain belief in what the value is. So the thing is I'm actually firstly, I'm insanely optimistic about the future of software, and so if you have a 100x ARR multiple company as a private company, like, congrats, conserve that capital. Try whatever you can to maintain whatever growth rate you can, but do it more efficiently than you were initially anticipating. And if you pull it off, then there's a very possible chance you'll kind of grow into that valuation, and you just maybe won't have to go to market from a funding standpoint for an extra couple of years. And then when we reemerge and things are more sustainable, then you could do an up round in 3 years from now. But like, the worst position is you get that high valuation. You brought in $100 million of investment, and you're just, your quarterly, monthly burn rate is $5 million a month. I mean, then that's a very, very dangerous spot, in which case you will definitely experience a down round or something with crazy protections and ratchets that'll look so ugly you wouldn't want to participate in that. But I think that, like, I would say people that are fundraising now obviously expect lower valuations. People that just fundraised, keep that cash, get more efficient, and see if you can kind of, just work through this environment.
Got it. Well, you recently tweeted it's counterintuitive, but raising less money will often lead to building a better business. It forces you to have constraints, which leads to more focus and higher quality decisions, which results in better product and more sustainable business models. So that's bad for my business model, right?
Yeah, you have to deploy capital.
That's actually really bad advice, and I don't think that's true. No, but what are the constraints when you're operating in the like public markets? You have to show cash flow, and there's trade-offs associated with that. How have you actually seen that manifest itself, and why might these constraints be good for entrepreneurs today?
So this took me a while. I had to like A/B test every possible thing, whether I knew it or not. And I can just say to anybody listening that is a founder or whatever, like, the constraints are actually lead to a better business. In the unconstrained environment, what you found, and we found this as well, as we needed to get more profitable, you would just see so many different sort of like projects emerge. And so like you've got a project for that will pay off in a year from now. And then you got a project that'll pay off in 2 years from now, and a project that'll pay off in 5 years from now. And like instinctively, you're like, that's great. We're making lots of little bets, and we'll sort of see what plays out. But all of those little bets are taxes on the organization. It's meetings that people have to be a part of. It's coordination you have to be able to go and do. It's more people that have to be hired. It's more support infrastructure for all those initiatives. And then all of a sudden you kind of start to maybe be a bit less sort of judicious on your and disciplined on your decisions. Like, well, maybe that speculative future AR thing maybe could work. And so I'll throw 5 people on that. And you kind of you start to don't even have like then a real heuristic anymore for how to make decisions and what kind of investments to make. And so in that unconstrained environment where capital is free because you're not really getting diluted that much and it's abundant, you start to build up all of these little things across the organization. And that's actually will make your company worse off, because what people, really thrive on is clarity, alignment, focus, a clear plan, being able to execute in a sort of a kind of a very forceful way in a single direction. And the more kind of just distractions and chaos and meetings and integration syncs you have to do across the organization, that's going to slow you down. It's going to serve your customers less in sort of what they need from you today. It's going to kind of just reduce your ability to make good business judgment decisions. So I've generally found that having those constraints, and it can be in some cases, it can be truly arbitrary. You could just say, we're going to run the company at a 10% operating margin. And then every decision we make has to be made from the lens of what we have a scarce amount of resources. We're going to put that scarce amount of resources in the most impactful things. That will force you to rank and prioritize what is the most important set of things. That will let you channel your energy in those areas, which will actually likely lead to a higher predictability that it actually pays off. So in our world, that today is 20+%, operating margin. And in the future, that will only continue to go up. But those are the constraints that we've sort of put in place. And then as a result of that, we have a bunch of sort of underlying components to those, constraints. What is the sales efficiency we need within our sales organization? What's the amount that we want to be able to deliver on gross margin? And guess what? Like, just another random one. Gross margin is this perfect one where, by having, again, whether it's arbitrary or something that is like super, pertinent to your industry, having that as a fixed level that you need to commit to is going to force the organization to build much better products, much better unit economics. You're going to think about your infrastructure very differently. So those are the kind of constraints that actually lead to better business building.
Has most of that stuff, from your perspective, like, is that lessons that you've taken, from public markets and having to exist under that scrutiny? Is that where you've gotten a lot of it?
It is, but I want to give credit to even, many of our VCs thought that way. We had a cohort of VCs that had been at companies in the 90s, and they had seen the dot-com bubble. It was fantastic to have VCs that had been through the dot-com bubble because they know exactly how things can kind of turn the other direction. So we had many of those constraints. The reason we were high burn at the periods we were high burn was we made a calculated bet that every customer we acquired would be worth, 2, 3, 4, 5 times more from a lifetime value standpoint versus the cost of acquiring them. And in an enterprise SaaS, if we can acquire, an annuity of $1 million for $200,000, that might look like we're burning, $200,000 in that first year or whatever, but we think it's going to pay back $1 million. That was why we burned so much. It was a high conviction bet on our particular market because the economics were sort of built into what we were doing. But that's not true of every business. And even in that case, we still spent money on things that we shouldn't have spent money on. I remember, at the sort of peak insanity of in our particular situation from a burn standpoint, that's like 7 or 8 years ago. I was like, gosh, should we do an enterprise software Super Bowl ad? And I sent an email to a couple of board members being like, would this be a good idea? We'd be one of the first companies in enterprise software ever in SaaS that would do a Super Bowl ad. And they're like, no, it's a horrible idea. And we're like, okay, shouldn't do it. And we didn't do it. So that kind of discipline getting built in is usually a good idea as you're scaling a company.
That's a good segue. Super Bowl ads is a good segue into crypto.
Okay.
So you're here to announce your crypto strategy for Box, right?
Yes.
So obviously Box doesn't actually have a crypto strategy.
I think there's room for more stable coins right now.
It seems like it, honestly. It's a little bit of an oxymoron here. Jumbo shrimp, stable coins. So do you, I guess just a level set, do you own crypto personally?
My exposure right now is, last time I checked, Coinbase was $2,400.
It's amazing how that your exposure keeps going down as a percentage.
Exactly.
For me, being indexed to high growth stock tech, both of them are actually following each other in lockstep, but it has been a little bit of a volatile situation. So I guess you were one of the out of the Web 2 world, I guess, which seems to be used pejoratively by the Web 3 community. But
out of people that just build software,
as people with real businesses, you were one of those. What's your perspective on the the state of Web 3 right now in general, and where I guess the ecosystem is?
The Web 3 is this one's a complicated one. It's like there's a lot of cognitive dissonance because I actually think like I'm answering a thing which is just a made up, like I don't even know, like if you made up a thing and then I had to answer about a made up, like I don't know what to do. But sure, the concept of more protocols on the internet and more openness on the internet and, more open source and more interoperability. Those are great concepts. And those are things that people have been striving for decades and decades. And there's so many robust ecosystems building amazing open source projects and new protocols that allow for more interoperability between software. There's sort of our arbitrary idea that somehow we have to do that on a blockchain. I just like think of as well, somebody just said that is the case. And then somehow we have to now talk about it. Why would it have to be a blockchain? Why do I have to pay a tax to replicate data 1,000 times for censorship resistance when censorship, for these types of use cases are not like that sort of relevant. So I would just say there's some philosophies that are being talked about within Web3 that are totally, interesting, great philosophies. And those are things that many people have been talking about for decades and decades. Matt Mullenweg at WordPress. That is the foundational, of WordPress is let's have more open source software that powers the internet. And then we'll have some commercial elements to it that people can participate in. That's great. But most of at least today, how Web3 is defined as we're going to use blockchain technology to power, things outside the financial realm. They just don't add up technically, or user experience wise, or frankly, I don't even believe demand from regular consumers. So I just don't think there's that much to even work off of.
I mean, some of the premises of like shared governance and ownership and decentralization, I guess I think are all interesting. And the currency example, I think there's stuff there, and it seems like people, maybe less so today, but people are willing to pay for some of the NFT use cases, right? But has there been a use case of Web3 that you've said like, oh, this is interesting. This feels like a hammer and a nail rather than a nail looking for a hammer?
So there have been actually, but then somehow I haven't seen the industry do the things that would relate to those use cases. I guess to me, like if you start at the most abstract concept of all, should there be a way to store things in a data store that is sort of always going to be universally accessible by you within some context that you can always get back to and don't require any corporation to sort of intermediate? Should that exist on the internet? I think that's actually a fine. Yeah, absolutely. Great. That's cool. That sounds good. Does that thing have to fluctuate in pricing? Does that thing have to be 24/7 traded? Does that thing have to be something where you lose it because you lose your keys on a phone and then it's gone forever? Does that it's so like some of the underlying concept of the idea of a decentralized data store that lets us access, and retrieve things from is like, okay, fine. I totally stipulate that's interesting. But then by the time it ends up manifesting as actual use cases, it gets so derailed. And there's a good reason for it. It's because that thing that we just talked about would probably, like on a global scale, be like a $10 billion idea. Like that would be like the TAM of that use case. Because it would just be like, well, okay, how many things do you need to store? And what's the cost of that storage? And how many people need to access that thing? And it's just there's not that many things that fit that attribute. So the only reason why it's a $2 trillion TAM or whatever we want to say the market cap is because people have said, no, that thing is going to power the ability to have, virtual Gucci products. And those things then can be traded between people, and then and you'll get rich. So it's like, yes, like the idea of a distributed data store that nobody controls is interesting, but the manifestation of it that has made it in the popular zeitgeist is because people are spending unbelievable amounts of money on virtual goods and things, which basically, I mean, the funny thing about even NFTs is like on a technical basis, they all basically just approximate another altcoin. They're all like, so everything is really just another altcoin, whether it has a picture associated or something else, it doesn't really matter. So it's just like, is somebody going to believe in the future that X new coin is worth something? And I haven't been convinced that there's a lot of use cases that would cause you to say yes.
What do you think the rhetoric, we were joking about it earlier, but what do you think of the rhetoric of like not going to make it, and Peter Thiel calling Warren Buffett the grandpa from Omaha or whatever, and you've mixed it up of who owns
I think
Web
it was the sociopathic.
Sorry, sociopathic grandpa from Omaha. There's been the like who owns Box. I think someone tweeted it and showed all
retirement funds. Yep.
Yeah, exactly. like pension plans. Yeah, all these terrible people. What do you think that rhetoric is? Like, is it acting in poor faith in like a religious sort of zealotry that you're trying to convince people to go somewhere because you think it's where it needs to go, and so you have to be that vitriolic in how you approach all these things? Or
well, I think here's the. I'm going to sort of pivot the question because I don't want to. I can't get into people's like psyche.
No specific. In general, they're not going to make it ethos. What do you think that is?
I mean, part of that I think is a shit posting and silliness on the internet. Like I'm not so kind of worried about that. Everybody kind of it's obviously kind of goofy that there's a lingo around it or whatever. But I think it's I think that there's there's a group of people, I don't know how large it is, that do think that the internet could operate differently. And there's an excitement around that, especially because the prices of these things have been going up. And I feel bad because somehow I look cynical by just saying totally normal things. Like no, just like build software that people pay for. And then that's how you'll know if you're creating value. But I don't know why that's cynical, but it's like, that's just like pretty normal. But like, so I don't want to rain on anybody's parade. But the problem is unfortunately, when you really break it down, the technology is not a good fit for most of the things that are being sort of theorized that it's going to solve. I mean, like the idea that it is a slow database is just, yeah, it's a slow database. So then the reason you need L2s is because the database is super slow. So we have to build up all of this other infrastructure because the underlying foundation of this concept is not particularly germane to most of the use cases people wish that it would relate to. And so I mean that I think unfortunately there's maybe an audience that is not as sort of like they haven't done all of the in-depth research on that and tried to think about, well, how does this all play out? And I happen to have had maybe too much free time to think about it, and a cohort of tech people also that don't agree with it, and I kind of built my conviction that it's not going to work as a result of that.
Yeah, got it. You're a student of internet history, and you've lived a lot of this. How do you think this all ends on the crypto Web3 side?
Well, I mean, again, I think that there's like, you got to stay super grounded in just the pure facts. Like, what would you use one of these data stores for? And if it doesn't kind of comport with the use case that you're presenting, then it's not going to ever work. So when people say, oh, okay, we could rebuild Twitter or social networks or a search engine or YouTube on the blockchain, it's like, no, you just can't. So the only way that can end is like, it can't happen. So that one's out. The idea that people want to sort of have digital goods in a metaverse that they store in a public blockchain, I guess is like, okay, I could see that scenario. But the problem is think about all the intermediate steps that have to go right. Like the metaverse has to be there that people want to be a part of. Like that needs then large scale ubiquitous consumer adoption for the goods to be valuable in them. So, by any reasonable guess, that's 5 to 10 years away. And that's even asserting that people want that. So what would you invest in now that would deliver a valuable outcome? And so from the internet, student of internet history is like, people always say, well, this is like the internet in 94. Well, the problem with the internet in 94 is nobody made money on the investments of the internet in 94 because nothing had been yet sort of built out. And so yet we have $2 trillion going into this thing. I mean, again, it's not really $2 trillion, but like notionally $2 trillion of value is in a thing before we have any of the actual infrastructure that would credibly produce the outcomes that people are talking about. So it's like, why would you then invest? Like wait for the thing to exist and then invest in the assets that are related to it. But that's not happening. So, and this would get too technical, but unfortunately I'm also just convinced that we will always say that it's the internet in 94 or whatever the time frame is. That's a perpetual thing that will exist forever. Because there are also just unfortunately like game theory reasons why very few of these things ever reach scale, which is the moment that you have any sort of scale from a coin or a token or an infrastructure, the users or investors of that infrastructure start to see less upside on an incremental basis. And so then they're looking for a new asset that they can go and invest in and participate in for the next rise up. And so you have a very unstable kind of network effect, which is the more people on these things, actually, the worse it is for the future users on these platforms because they don't have the same financial upside as the earlier users. And so the reason why that's super problematic is that's the exact opposite of how we know how to build internet scale systems. Like the more users on Airbnb, the more houses are on Airbnb, which then creates more users on Airbnb. The more users on YouTube means more content gets generated, and then that brings in more users. The more users there are on Bored Apes or whatever, at some point someone says, wait a second, like this has to plateau. I need a new asset to go and buy into. And then there'll obviously be some asymptotic point where then it should then just go down at that point. So there's anti-network effects in every single one of these models.
When you're speculating for returns around this stuff, it's just inevitably the last person in is not going to get the same amount. Yeah, no, it makes sense.
But like that's not like you can't solve that.
Yeah,
like,
that's perpetually true.
More software, more human behavior changes. Like everybody says, well, no, like the community will shift to being about utility. It's like, no, come on. You can't for the first X number of years build a community that wants profit, and then somehow you're going to like navigate this very graceful shift to then they all of a sudden only want utility, and then they're doing it. Then they hold on to their tokens just for the good nature of for some reason. Like that's not how people work. Like they want a financial profit at that point. So what happens when they start to sell the tokens because you've now shifted to utility? Well, then the asset collapses, and then people move on to a new network. So that's just an ongoing that will happen for every single asset.
Shifting gears, so recently there's been a move by CEOs, I guess, led by Brian Armstrong from Coinbase, and then Toby Lutke from Shopify has followed as well, where it's like, hey, we're going to keep social issues and political issues out of the workplace. It seems like I was looking at the Box official Twitter account. You guys issued a statement about Roe v. Wade and the leaked Alito opinion on what's going to come out. So clearly you've taken a different tact there. How do you think about that from a conceptual standpoint?
I think you have to certainly pick the topics that you think are important enough for your culture and the health of your culture and your organization, and so we're not going to take on every single topic that would sort of not be practical or appropriate. But there are some that maybe it's a healthcare topic, maybe it's a social justice topic, maybe it's something that is purely economic, economics oriented that we'll take on. Where the company needs to make a stance or a statement or have a message in support of something. And it's, it's not a consensus. It's not like we're not going to vote on that. It's going to be the topics that in our best judgment represent the stuff that's going to be important to our workforce and our culture over the long run. And so, only a few people can really ultimately be accountable for what those things are. I'm one of them. But it's based on what sort of I'm seeing from the organization and our own, kind of culture and beliefs about our organization and business going forward. So I think it's actually fine for companies to take completely different approaches to this. So I certainly watch Toby and Brian and what they're doing, and that's one approach, and we have a different approach. And I think it's kind of interesting and good probably that there's a diversity of approaches in how organizations operate on this front.
No, it makes sense. What about shifting gears to Elon and Twitter? You've joked quite a bit about this, but are you optimistic about the platform as someone that uses it regularly under Elon's leadership?
I think, this is, you have to kind of like parse out two concepts, right? So on one thing, you have to say, okay, will it be a well-run company with lots of innovation, executing super well? I actually would say yes. Like if you just look at his businesses, they tend to have that characteristic. So as a business leader, entrepreneur, I'm not sure that I'd ever want to like work directly under him. It sounds like that would be like, oh my gosh, like you get an email at 3:30 in the morning and you've got to, do like, I think he does like standing meetings at 11 p.m. for like new SpaceX, rocket design. So it's like, holy shit. So
concentric circle of working for Elon and at Twitter seems like a tough, that seems like someone that enjoys pain doing that.
Those could be pretty, yeah. So on that end of like, will the company do great things? I would say yes. I have no at least immediate concerns or paranoia about that. On the other thing, which is like, is he going to somehow solve, world hunger on censorship and free speech online? That's dubious because I just think it's a much harder problem than even maybe he's kind of thinking about. I've watched his Chris Anderson interview at TED, and it was a little bit maybe too high level for my liking of like, okay, like, do you really understand the intricate details of every single region has different kind of cultural norms and laws, and you're a global platform, and how do these things interrelate? And so I just think it's a super hard problem. I think it's so easy for people that have a particular point of view, including, I mean, both sides actually. This will sound like it's sort of, talking about more of the right, but actually I see equal stuff like the Joe Rogan controversies of, we should censor Joe Rogan. It's like, well, no, but like, so where does that line get drawn? What sentences can you say? What so I think both sides don't really understand how practically, how hard this stuff is. But my basic guess is like, other than maybe like crypto bots, like nothing really gets that much better. Like maybe an extra 100 people have their account on Twitter. But like, you still have to solve harassment. You still have to solve abuse. You still have to have, systems in place for the different regions that you're doing business in. So I'm less I think there's less of a delta of what will actually happen from a censorship standpoint, just because I think like these are just really hard problems that will have to continue to get solved if you want any chance of having a healthy, kind of platform.
I think if you go back and watch that, the Chris Anderson interview, it's clear at a minimum at that point in time, it wasn't the most thought through in terms of like what the long-term vision is. Yeah. And he's obviously a brilliant guy.
But here's the thing. It's not even unfair to him, actually. This is the thing. I mean, Jack, if you're out there, like I've seen the same answers from Jack. The reason is because these are truly not binary things. So you always, like after you do like the 5 whys, eventually you get to like, well, in this case we'll do this, and in that case we'll do that. Like there's no way to write it down.
And what's ironic is the platform itself actually doesn't lead to any nuance at all. And
Right.
so it's ironic that the problems on the platform require nuance, and the platform itself doesn't allow nuance.
Right. So like I don't think that there's anybody that is going to solve this. I actually think we have to accept like a certain degree of unhappiness.
Yeah.
And actually, maybe that was the most thoughtful of Elon's thing, which is like 10% of liberals, 10% of conservatives are going to always be unhappy because yes, Joe Rogan will be able to bring on anti-vax people, and also somebody who does a Capitol riot is going to get banned. Like you might just have to accept that those are going to be the polls of what things people are going to be unhappy about, and we got to just sort of be pragmatic about this a little bit.
Yeah, no, it makes sense. Do you feel responsible for Elon's tweeting in some way?
No. What do you mean?
You don't. I feel like you were one of the first people to be public and say, hey, I can have a serious job and also make jokes online. And I feel like Elon has taken that to its outer extreme. But
I think based on the tweets Elon does, he would have independently come up with that conclusion.
You think he's
his meme game is at a level that nobody could have influenced that.
I agree. I agree with that. But no, it's interesting. I will say, I mean, I've benefited from this as well. I remember when I was first started tweeting in earnest, it was the beginning of the pandemic. And someone said to me, which I took as a great compliment, like, oh, there should be a Aaron Levie of VC. I think you can
just like high burn and
that's right.
Okay, got it.
That's
okay.
right. Yeah,
okay.
that's right. I think they wanted me to be able to make jokes on the platform. I think was they were alluding to. But have you had any funny anecdotes or things that have come out of tweeting and being a public figure? I assume enterprise sales deals don't get closed from it, but you probably have higher visibility than.
Yeah, I mean, I think like I'll interact with CIOs that are like, thank you for talking about immigration reform or something. So like that will happen.
The more substantive
side.
Of
Exactly.
Usually, not the jokes.
Usually not like thank you for making fun of robots.
Exactly.
That stuff doesn't come up as much. But no, probably the most fun of all time was like 6 years ago. I don't even know what caused it, but Snoop Dogg responded to a tweet, and we went back and forth where I made some marijuana jokes that I didn't understand, and he responded, and that was a great time in my internet.
Yeah, you were
history.
being fed those jokes.
Yes, I was pinging all my friends.
Yeah,
like, what's
exactly.
a good response?
Yeah, if your public investors are listening, definitely being told that stuff. Now, how far we've come. Now Elon's literally smoking weed on Joe Rogan.
It really doesn't
and
matter
making
anymore.
420 jokes. Yeah, I made a joke that Jack Dorsey, after the Web 2, Web 3 thing, was never going to be able to work at Andreessen Crypto anymore.
Yep.
And he responded to that.
What did he say?
It was a picture of him with like tears streaming down his face. And I will say my mentions, like I still get responses from that. It's actually amazing
it just keeps going
as a platform. It's interesting. Now I will say VCs and CEOs seems to have taken it to its outer extreme now.
Yeah, we're just getting bored at this point, is what I think. I think we have too many VCs and people that have been just on their computers for now too many years. And
our brains are all broken collectively at this point.
Yep.
Yeah, I think that's probably right. Well, one of the other things, we're obviously in Box's HQ today. So where are you guys in the state of working now? Like hybrid? We work. Yeah,
we're working.
Yeah, you are. Yeah, that's awesome. That's good to hear. Yeah, doesn't smoke weed to your public investors. Doesn't smoke weed and does work.
Yep. Yeah. So we've opened up offices, and we're probably on the, I don't know, like 90th percentile of orienting toward flexibility, which is funny because 2 years ago I was the most in-office oriented person like that. Like I was basically 6 days a week in the office, and you'd have meetings, on some planning session that go till midnight. And pandemic, I was like at first like, how are we going to replicate all of that? And we've seen a lot of benefits of the diffuse nature of, well, now you can actually involve more people in the conversation. We get, we can be more global, on the margin. There's obviously much more flexibility of like, okay, maybe people, do need to spend more time with their kids or whatever. Like, what a brilliant idea. And so that flexibility has been now baked in. And so people, I think, will come in a couple days a week if they're around an office. But then we're going to stitch it all together still with a very digital first orientation. We benefit from, like, literally the product of Box is about being able to, collaborate from anywhere at any time with anyone. So in the literally like the initial business plan of the company, we talked about being able to work from anywhere. So that was just like a founding characteristic. And so we're just going to exploit that to the extreme of the kind of software we build to help companies that need to collaborate and share and work from anywhere at any time securely.
How do you make the hybrid employee that isn't in the office not feel like a second-class citizen? Because I feel like we're entering this world now where historically there were the automatics of the world or the elastics or the people that really pushed remote. And then we all went remote, right? And now we're sort of stitching back together into this weird hybrid world. And one of the concerns I have are a lot of the people that aren't in office are going to end up feeling like they're not as valued of an employee as the ones that are.
I think that's a good sort of concern to have because we're going to have to work against it. So far, I'm almost seeing the opposite of like the people that are in the conference room, are actually at the disadvantage because the people who are in whatever the remote environment is, they've got bigger, screen real estate for looking at whatever the presentation is. They see each person. So I'd say there's almost like a, kind of counterbalance because technology has gotten so much better for that remote or offsite, kind of worker that it kind of is balancing out. So, but we're so early. I mean, literally, and even in the case rates, people are deciding to come in less frequently, as there's more COVID, at least in the Bay Area. So I think we'll have to, let's check in like 2 years from now and see where things land.
Yeah, it's interesting. One of the last ones, do you feel like, I mean, you obviously rode the cloud trend, and then we had mobile and potentially we have blockchain, but do you feel like there's a shortage of frontiers right now from a technological standpoint for entrepreneurs to pursue? Because to some extent, the cloud was the same cloud that you started. I mean, obviously it's changed how you approach and build these companies. But
well, so I'm glad you brought this up because actually I should have said this in the Web3 thing. So can you like splice this in?
Yeah, sure.
Okay, I don't know, whatever I do. So this is actually maybe this is the part that I take most kind of personal offense to, which is when you say Web3, it from just a terminology standpoint, obviously like implies the successor to the web. Like
it's pejorative to Web 2.
Yeah, well, like iPhone 12 was better than iPhone 11. Like I mean, like I don't even word pejorative. Like I'm not like offended as in like because I just know how software works, so it's like not offensive. It's just the implication is that Web 3 somehow is better than Web 2. So first of all, there's two issues with that. One is you're kind of saying that like Web 2 has run its course, and so now we need the new successor. And then the second is that this is somehow better, which it's clearly not on every economic, technical, UX, basis. So let's even remove that for a second. And now Web 2, let's just say the thing that, and this is probably coming from a place because I'm in enterprise, so I can afford to just be more boring. Like we just need to build software that people like, and then we sell it to them, and they pay for it. And if we're solving their problem, that's how you build a business. So I think some of my instincts come from just where I spend my time. I think there's still unlimited potential on the internet. And so like, I just don't think there's always this sort of search for a new frontier.
Yeah.
And I think that we get more bored much sooner than the rest of the world gets bored with what they have or within some of these paradigms. And so I think, whether it's VR or AR or AI or blockchain or all this kind of stuff, a lot of this is just our industry is sort of like seeking more stuff.
Yep.
And so it's our own impatience and it's kind of ADD as an industry that's sort of saying, well, this is definitely the next thing. And I would just say like, well, mobile is we're now a few billion people into mobile, and cloud computing, we're probably still in the early phases of all things going from on-prem to the cloud. So both of those trajectories still have a lot of runway. When everything goes into the cloud, most things that are in the cloud still kind of look a little bit like the things that were on the desktop. So there's probably needs to be an all new era of then the stuff that actually gets built in the cloud. Like Figma is just 100 times better than what came before. And I'm seeing the same thing in like CAD design software and video editing technology. And so like those things are no longer just replicas of what was on our desktop, but they like
client server to cloud. We're actually building new experiences.
They do new things. Exactly. Shopify was really the first breakthrough in some kind of decentralized or distributed commerce model that could actually
much better than ATG or whatever.
Yeah. So these things are actually fundamentally better. And I think that we still have hundreds or thousands or tens of thousands of ideas left that are within that realm. And so part of the frustration is like thinking that we need to like randomly change the architecture of the internet for a next, kind of wave of innovation, when actually cloud computing is still in its infancy and it has so many more things that it can be delivering, from data models and cost of storage and cost of compute and graphics and just all of the things that we still have left to build for just like literally how the internet works today. So I'm very optimistic. I think there's a ton of innovation. I don't think we are sort of in need of more frontiers. I think the frontiers will emerge as consumers demand them. And it's like kind of as simple as that. So when all of our friends outside of tech and family are saying, oh my God, VR is amazing, that's when the frontier emerges. But you're not gonna like force a frontier onto the world somehow. Like the physics have to be great. From the device side, the compute has to be fast enough. So we're still early in many of these new frontiers. And so I think entrepreneurs especially have to be very pragmatic about what they bet on. Last point on this. Sorry, I'm going to throw you on the bus. This is the VC asymmetry with the entrepreneur kind of model. Like as an entrepreneur, you come into a job and you just like work like all day long on one thing. As a VC, you get a portfolio. So you can be like, okay, I can like, these are 3 things, these are 10 things, these are 20 things that I can, kind of bet on across different industries. And so the challenge is I think sometimes VCs are the ones wanting these new frontiers because, there's capital that needs to be deployed. But, I just have seen friends in, 15 years worth of doing this where like, they'll just go follow some new trend, but like there was no real consumer demand for that trend. It was just something that like we created an investment bubble around. And then people thought that there would be a real trend there. So I think we have to be kind of pragmatic of where's really the consumer pull? What problems do consumers or businesses have that some new technology is going to solve? And you got to just kind of simplify at that level. Otherwise, we're kind of manufacturing and inventing a bunch of trends ourselves.
No, that's a good one. Well, last one, ABBA.
Yes.
Huge ABBA fan?
Mostly that's a joke also, sorry.
It's been going there for a long time.
Yeah.
Well, good. Well, Aaron, thanks for doing this.
Thank you for coming over.
This was fun.
All right.
I appreciate it.
Good to see you.